Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Hello, welcome back to the Wade Borth Podcast. Today, we're going to continue our series of reviewing Nelson Nash's book, Becoming Your Own Banker, The Infinite Banking Concept, with Nicole Tate. Nicole, and I just want to say thank you once again for your perspective as we do talk about what was your hurdles when you first got started down this path, and then also because you're fairly new and not totally new to the concept, what that looks like, and bring some perspective back to the listeners as far as if I'm just getting started doing it 2 or 3 years, or if I've been doing it 15 years. It's always good to hear other people's ideas and thoughts around what Nelson has written in his book and how you interpret it and how you read it, because there's so much stuff and so much information here. So again, my thanks for joining us.
Well, thank you for asking me. I appreciate this. I learn every time I go through this book, and these conversations really make me think about things a little bit differently too. And it's nice to be able to share what my perspective is, because I do hear my own questions in my clients' questions.
Yeah, we typically do. And it's just, and the questions are rarely are they completely different. So most people have the same 4 or 5 type of questions in regards to a lot of the things that are in the book. And they might say them a little bit differently, but in essence, they come down to the same thing. They're just searching for a little bit of the why, right? Why are we doing this? What makes this, what sense does this make? Or I don't get what he's saying here. Can you expand on this? So hopefully by doing these series, we're able to expand the thought process of people and give a little insight to what Nelson was saying, at least how I read it and how you interpret it as well. But it is imperative that you do read this. It's like owner's manual for controlling the banking function of your life. It shouldn't be something you just read once and sit down. It should be something you read and then reread and then go through it again. And once you've had experiences and once you're gaining on your knowledge and you're gaining on your experience, go back and reread it, because then it's a completely different read. And that's the fun part about doing this, is that as we go down this journey, down this pathway, every step brings us different experiences, and then we go back and reread the book. We're finding new ways or new things that are being told to us in the book as well.
Yep. As you learn to apply it, you begin to see things that you didn't see before.
100%, exactly.
Yeah.
And so today we're going to be talking about how do you start building your own banking system. Page 41 for those that are in the book, but again, how to start building your own banking system, in which this is really important, because I think it's like anything else. Getting started sometimes is the hardest, right? We might have an idea of how to address some of the issues that Nelson brought up before, but it's okay, now with all that, what do I do with it? What's the next step? And I don't know if that's what you discovered in your journey as well.
It is. I was really excited. Here's some other things that you need to think about. Now it's okay, so how do I do this? How does this actually work?
Exactly. So if we get into the book, it's interesting because Nelson makes a point, because he goes back to page 17 where he's talking about the average American, I think is what he calls them. And the all-American man, I think is what he said. What he pays in interest and what he pays in interest cost to other organizations that aren't his. And so as people look at it, and he makes a very clear point about this, and I agree with him wholeheartedly, is that they look at the very biggest number, which is your mortgage, and go, that's the first one I'm going to attack. And let's do this from a mortgage standpoint. And I've heard that from a lot of clients. They want to make that their number one thing on their list of saying, hey, if I'm going to do this, if I'm becoming my own banker, I'm replacing that mortgage. And I have to hold them back a little bit and say, wait a second, let's just take a look at what you have for debt. Let's take a look at where Nelson was pointing to was just on page 17 was just this all-American person that has debt and owes things. And he's just giving an example. And then where it becomes real important for us to know our client, to know who we're dealing with, is we have to understand what your debt is. I have to understand what my client's situation is. And then we have to be smart about, okay, which debt do we attack first? And I don't know if that's what you're running into as well. Or
it is what I'm running into as well. And into in my own life is looking at, okay, so because I think it is very normal for people to want to get rid of the mortgage. We're just pay off your mortgage as you can. And so that's the biggest expense typically. That's the thing that people gravitate.
And then in Nelson's book, to his credit, he wrote, if you do that, if you make that your number one goal, the majority of the people, it doesn't mean that one individual that's out there can't do it, but the majority of the people are going to be overwhelmed. They're going to have to build such a big system, and they're going to be overwhelmed. And quite frankly, if we really put it in a hierarchy of debt you want to get rid of, at least in my perspective, when I look at it, my home mortgage will be probably the last thing I retire versus the first thing. And the reason why that is, I see a lot of different debts different ways. So if somebody's got $20,000 in a credit card that they're paying 20% on, just instinctively we should pay that thing off first and have them take control of that function themselves. Pay back the 20% and do all the things about the banking process that we talk about, but attack in a systematic, orderly fashion. And the reason I say I want my house to be the last one I'll pay off, not that I don't want it paid off, I do. And if we ever buy a new one, I might not even get a mortgage because it is such a painful event to go through the mortgage process. But sometimes it makes sense for us to eliminate what I would call harmful debt and take a look at a mortgage and mortgage interest, saying that's not so harmful. It's less harmful than a lot of other type of debts that we can have.
Yeah, and I think with the mortgage, people get so focused on, especially in today's world, the interest rate is so low, but I'm paying it for so many years. I'm paying it for 30 years. So over a 30-year period, my interest that I pay, it's going to be whatever. It's going to be the same amount as the house or whatever that number happens to be. And so we get focused on that long-term amount paid in interest instead of looking at what the process actually is.
And exactly right. We have to practice the process. We understand how to do it, what we have to do. And Nelson says in the book, we need to think long-term. Are we thinking long-term? Right? Do we want to get rid of the house? Yeah. But think about it. How long did it take Nelson to get rid of the snakes and dragons in his life? It took him 13 years. Right? Yeah. And this was a guy that was focused and driven to do it. And so from that perspective, we should understand that this is a lifelong process, and we're going to get rid of things in order that it makes sense for us individually. So and part of what Nelson always talked about is that you have to have some imagination too. Logic and reasoning, right? So imagination, logic, and reasoning. Think about that for a second. I know the volume of interest on my mortgage is going to be big, but also if I just focus on that one thing and don't do these other things, then the volume of interest on my automobiles, on everything else I'm doing, my financing, is going to be big as well. So let's attack one, something that we can handle, understand the process. It's like practicing. My son plays trombone. He doesn't go from being, a first-year trombone player to competing at state level overnight. He has to have the practice, and he has to go through the process so he understands how the thing works. Same thing here. Let's not start with the biggest mountain. Let's start by taking some trial hikes and getting our legs in shape, and then we want to attack the big thing.
Yeah, we didn't get into the situation that we're in financially, and we're not going to get out of it overnight either. So we have to begin to attack it little by little, just as though you were trying to lose weight, 100 pounds overnight, and you're not going to lose it overnight either. You have to go through the most important things first, and then you have to identify what those important things are to be able to attack them.
Yeah, and that's a good point. And so that leads into, he mentions, he says, first, let's try financing automobiles. As a practitioner, as being part of some of the very first think tanks, we were always asking Nelson, why did you pick on automobiles? And he didn't have any particular reason. It was just that it was real easy to demonstrate. It was something most Americans have and have multiples of as vehicles. Unless, of course, you live in New York, then you may never own a vehicle. Who knows? But most Americans have vehicles. They understand financing vehicles. And so to him, it was just made sense that let's give an example of something that everybody has. It was never intended to be the very first place, and it shouldn't be the only focus to talk about vehicles. It's just an example of, here's something everybody has. Here's an easy example for your imagination to get its arm around what's going on here. And so we can break it down through the process. Because quite frankly, I'm a firm believer in starting with controlling the banking function in what I call wealth building assets. Let's start there, right? If we want to buy rental properties, or those things are going to grow wealth, then let's use our banking system to do that first. And then come back and take control of other things that we're financing. Because then we're going to have a passive income as well as controlling the banking system, the passive income from those wealth building assets. So I think there's a lot of area for discussion talking about where we should start. And Nelson was just doing that in the book as an example of, here's something everybody should understand, assuming that everybody had financed a vehicle once in their life. So in the book, again, we're still on page 41. I use the example, and I don't know, Nicole, you probably heard me talk about this before. If I'm talking to clients, I'll ask them, I'll say, if you have 100 people, if I go out and survey 100 people out on the street, and they have a savings account, let's say the savings account's got $50,000 in it, and it's earning, let's say it's earning 1%, just for easy math, right? So that's $500 it's earning. They take that $50,000 and buy a car. And again, we're just using a car because it's an easy one to understand. Nelson, in the book, in this figure 1 on page 41, he talks about the 5 different ways to finance vehicles. And again, he's talking about financing vehicles over a long period of time, not individual vehicles, but the financing of them over 40 years. And so when we look at it, the first method to talk about was the leasing, right? To his point, and I've heard people say there's some great lease programs that you can do a lot of different things. And leasing is just about cash flow. It addresses the cash flow problem people have about paying for a vehicle. It has nothing to do with value. It has more to do with cash flow. I want this big, expensive vehicle, but I can only afford X amount of dollars per month. So therefore, it's a lease. And all a lease is here's the purchase price. Here's the price in 3 years, given so many miles. Here's what we assume the price will be to buy it back. And you take that difference, apply a little bit of interest rate to it, and that's what your monthly payment is. So yeah, from a cash flow perspective, it works, but is it the best way to buy vehicles? That you need to decide that. But that's one way you could do it. But you have to understand that somebody has to buy it. A lease just means that somebody buys it, then they turn around, and then they, in essence, they lease it back to you so you can use it, and you're paying for each monthly use of that vehicle, and the depreciation and the use of that vehicle. So I think it's people make a lot about leases, and they say, oh, it's a great deal. I've heard people in the IBC community talking about car leasing, saying it's a great deal. I'm like, yeah, it's usually great for somebody, but I don't necessarily know if it's great for you or I to do that.
Yeah.
So
I thought it was, he puts in here, reason tells. So he talks about leasing versus buying it from the bank. And he writes in here, he must lease from an owner who had to buy the car. And I think we forget that sometimes. So we think it's such a great deal because my payment is only X dollars instead of this amount of money if I was buying. And it's not that I don't want other people to make money, but if we're talking about creating our own financing system and taking control of our own, why are you seeking that out to somebody else?
Yeah, think about, and this is so true. I know a couple of clients and friends of clients that have made a lot of money starting their own leasing company. They start their own leasing company. So they don't get rich by having it be a good deal for you, right? The consumer. They become rich by having it be a good deal for the guy that's buying the car and leasing it out to somebody that doesn't want to make the payments. I've seen this with medical equipment. I've seen this with other equipment through some leasing companies. The thought was even, should we band together and start our own leasing company? Isn't that difficult. You just get enough capital to buy the equipment that's needed. And then you find somebody that wants that but can't afford the down payment or can't afford the cash out or what it would be. And so they just want to make payments. Then let me do that for you, and I'll be the one that makes the millions off of that. So starting a leasing company is a tremendous deal for the person that has a leasing company. It's rarely a good deal for somebody that's buying. And again, there'll be some instances, especially with car leasing, because it's become very competitive, that somebody will say, oh, I got a much better deal on this car lease, and I'm making money because at the end of the 3-year period or the 5-year period of the lease, the price of the vehicle is appreciated more than what they thought, so their buyouts a whole lot better terms. But again, that's an anomaly because of where we're at right now. It's hard to buy used vehicles, so a used vehicle right now is bringing a premium, and so they're going back and saying, "See, my lease, I paid a small amount, and I'm actually getting more back out of it than what I paid for it. I bought it out, and I can turn around and sell for way more than what I paid for it." But that's an anomaly, and that's a risk. Are you willing to take? Again, it's about taking control of the banking function in your life. So a lease isn't a bad deal if you want to start the leasing company. Yeah. But to get a vehicle by the use of a lease, I think is foolish. So again, that's back on figure 1 on page 41 of the book. And so then it goes into the bank method B, right? Where traditionally you go to the bank and say, hey, I want a $50,000 vehicle. They're going to go, okay, here's what you're going to put down. Here's what your terms and conditions are. And you agree to them because you have no other options.
Yep.
I think the majority of the people would understand that.
Yeah, and I think between those two, I frankly know quite a few people who have paid cash, and I know that's the next method that we're going to talk about. But most people are either leasing or they're buying and making payments over a period of time because it's all about cash flow.
Yeah, they do that because they haven't beat Parkinson's law. They haven't deferred the need for that vehicle so they could build up a reserve. Now there are some people that will pay cash. So that's the next method, is the cash paying one. And those people are sometimes, they have a belief that it's the best that they can do. This is the absolute best that can happen. Is I'm going there, I'm saving money. I call it the zero line illustration, where somebody starts at zero, they save over maybe a 4-year period, get enough money to buy a vehicle, let's say it's 50 grand, and then they empty their bank account, and the next day their savings is back down to zero. And then they start the process all over again.
Yep.
And it's back down to zero. They never really get ahead of the person that goes to the bank and says, hey, I'm going to go and finance at the bank. And the only difference is the guy that goes to the bank directly has a little bit of interest cost. And the bank is making money off that interest cost. Right? So the guy that's paying cash is slightly better, but he's not a lot better. At least, and that's the perception somebody that pays cash is saying, I avoided all that interest cost. At 2% interest cost on a used vehicle or new vehicle, how much interest cost did you avoid? And then how much opportunity cost, or how much cost could I have put my money somewhere else and made a lot bigger dollar on?
Yeah. And that is I'm just thinking of one young lady that I have in particular who just recently bought a car cash. And so now all of that cash is gone. So she's square one. And just trying to help her think through this process. Gone. You don't get it back. You can't go back to the car. I need some of my money back because something else came up, and so I'd rather do it this way. It doesn't. So you've now given up use and control of all of that money.
Right. Yeah, and then if a great deal comes by where they can make 20 or 50 or 100% of their money in a short period of time, all they got is a vehicle to show for it, unless somebody's willing to give them a loan for that vehicle to get their money back out of it, which may or may not be the case. And it could take time. So it's about timing. It's about having access to cash.
Yeah.
Then the third method is what Nelson calls the CD method, which just means you put money in your CD and then you're just borrowing against that CD to make that purchase. So it is a process. But again, are we looking short term or are we looking long term? That's probably the biggest thing.
Yeah, and I think it's on page 42 where so he talks about this in the second column, continuing to fund the monthly savings into the account. The person playing on with himself, but he is using someone else's bank to do it.
Yep.
The dividend going to the stockholders of the bank, he is only the interest that the bank is paying him. So then there we're talking about saving money. He's only earning the interest that the bank is saving him, but he's using the bank's money. He's using the bank's system instead of using his own system.
And what's the big takeaway? The very last sentence of that cutout piece was the borrowing of, he's going to be the borrower of the money, which is absolutely necessary in the whole scene, where nothing happens without him, because he's the one that pays for everything. I think the real good key takeaway from there is that if you're using somebody else's system, who pays for that system? Who's the ultimate person that pays for that system? The person that's using it.
Yeah.
So the question is, do you want to be the owner of the bank or do you want to be a customer of the bank?
Yeah. That's a really good point.
But in that, there is actually some redeeming qualities to doing the CD method over everything else. So it's about accumulating a bucket of money to use as collateral. But again, you're accumulating a bucket of money at somebody else's institution, and then you're borrowing from that some other institution, and they're using your bucket of money as collateral to make that happen. There's some drawbacks as well, but the part that's positive about that is that, at least in the book, in the chapter here, he talks about you have to build this pool of money, right? You have to build a big enough pool of money to not just only accommodate your needs, but quite frankly, you have to have it big enough so you can accommodate others' needs in the future. And that's important in no matter what method you use.
It goes back to the bank. The owner of the bank doesn't just have himself as the customer.
Think of the grocery store. If we're back in Nelson's grocery store example, if we're the only customers that come in and buy the food off our shelves, pretty soon we're going to be out of business.
I think that was one of the most difficult things for me, is thinking about being the owner of the bank or customer of the bank. Because as I read through time, I was thinking, oh, this is really powerful. I like the idea of controlling all my own money and having to go ask other people for permission. and all of that stuff. But if you're the only one that's using the system, pretty limited, really. It can still be expansive. There can be lots of things that you have to finance throughout life or that you choose to finance, but it's going to be pretty limited because it's just you. But when you start thinking from infinite and you broaden that and go, okay, I'm the owner of a bank. Other people can now borrow from me. How do I want that to look?
Right.
Or really, you go, oh, okay, I get it.
Exactly right. That's where the power truly lies. The power lies in the control that you have by having your own banking system for your benefits and your needs. But when you can expand it to now include other people, what's that?
Yeah. I was just going to say, it's important to begin to build a community because people have to know that this is out there. You can't just keep it a secret to yourself because if nobody knows, then setting up your bank to be useful to other people.
Right. 100% agree. And Wells Fargo just doesn't lend to its board of directors. It's actively going out there trying to find new customers, new people to lend money to. And the reason why that is because they understand how interest works. They understand how the system works. And they're just applying these basic principles to everybody else, and they're going out and finding new customers. But the best place for us to hone our skills is in our own lives. We have to be great stewards of our own money. We have to understand how money works and how money flows, and maybe we experiment within our own system to figure out what we need to have and what we don't, and all the things that we want to do to become very proficient at the system, at the banking process, the financing process, we can do in our own lives. We can, if we make a mistake, at least we're doing it with our own lives. And then, but once you've crafted and honed that skill, then let's put the money to work. Let's really go out and put it to work. It's like a craftsman, right? It's like a carpenter that's a great craftsman. If all he does is build furniture in his own house, he's going to have a fine-looking house. There's going to be nothing wrong with that. But if he truly wants to grow wealth, then let's take that craftsmanship and then let the world know that you have it available, and then people will be bidding to come and use that skill.
Yep.
It's the same thing. And Nelson says in the book, too, that if you have money to be lent, he says good deals won't necessarily just even find you. They'll be coming knocking down the door because they need to be done. So this leads me back to what I was saying just a little bit earlier. If I go out, and again, knowing all four methods, right? So we have the lease method, the borrow money from the bank. We do the cash method, which it's funny when you talk to people, they go, oh, I pay cash for everything. I'm like, hey, that's great. That's way better than doing it at the bank. But they have a bit of the arrival syndrome because they think they can't get any better than that. And I find it rather interesting is that, okay, if that's truly the best you can do, why are people of wealth and why are institutions that make a lot of money doing it a different way?
Yeah. So because this, and we've talked about this in these podcasts, we've talked outside of these podcasts. So the feedback I often hear and talk about this in today's world is that you have to pay the interest to this company. So you're paying interest to the financing company or you're paying insurance company.
What is the difference? That's a great question. Have people think about it. Again, if you own the banking system and you have to acquire cash, but you're also owner of the life insurance company because you're part of a mutual insurance company, isn't that a good thing? Because my money can sit in my policy and continue to compound and grow the rest of its life. And when I need it, I can just reach out and say, hey, I want to take a policy loan. And then they give me a line of credit up to the equity that I have in the policy. Then I use it and I put it back. I never have to ask. So a lot of times it's not about interest. It's more about control. That's one of them. But somebody might say, well, I have to pay a fee somewhere. Yeah, well, why not pay it back to an organization that's made up of like-minded people that you're part of, that's going to benefit from the use of that interest, right? And then apply the banking. Again, it's buying an item. It could be cash, it could be a hammer, it could be a can of peas, buying it at retail, or buying it at wholesale, and then selling it at retail. It's all the banking system's about. And all we have to do is apply that to our lives. So if we own a grocery store, the question is, I can either go to Walmart and pay 60 cents for that can of peas, or I can go to the Wade Worth grocery store and pay 60 cents for a can of peas. What's the difference? The difference to me is I own the store that I want to see become successful. Or do I want to go to Walmart? In that sense, you would say your business, you love your business no more than you love Walmart. Again, we have to love ourselves and our family and the organization we're part of more than we love Wells Fargo. So when it comes down to apples comparison to equal interest rates, then the point is, why would I go anywhere else if it's the same interest rate? I might as well do the shopping at my store.
Yeah, I think there's a powerful control. And I think people that are attracted to infinite banking, ending that they control of their money. They want to have control. They don't want everybody people that don't know them, people that don't care about them or their family, to have the control, say yes or no when they need to use their money for.
Yeah, I agree. I was just talking to a client yesterday. We were having the exact conversation. She goes, I know I could get my money cheaper at the bank. But she says, I don't want to go through the hassle. She was busy enough the way it was. She says, I'm not choking over a couple of pennies worth of interest. But we've been conditioned to think that couple pennies worth of interest is the most important thing in the world. Again, we've been distracted by this magic trick of, oh, look at the interest rate. Well, okay, interest rate's just one function. How about the time it takes to acquire that money by going to the bank? Think about what it takes to do a mortgage. How many pages are in a mortgage application? 180, 200, 250? Do you understand all that's going on in that mortgage application? Do you know that they're going to come back and require another pint of blood about every 2 weeks until you get that mortgage? What's that worth, right? Is that worth the hassle? Is that worth a couple of pennies of interest? Some people might say yes. Well, then, okay. But think about it in this way too, is let's say you could go to the bank and get a loan for a point cheaper than what the insurance company is going to charge you. Okay, then take advantage of that. But now you have a choice, because now you have a choice to say, hey, I'm going to use my banking system, or I'm going to go to Wells Fargo. I'm not advocating using Wells Fargo, but if that's what you want to do, but now you at least have two choices. Before you had just one option, and that's not a choice. You had to go to the bank.
Really not a choice.
Exactly. And that's typically where people that are financially enslaved go, because that's the only option they have. And so you have to live by the terms they're giving you versus the other way around.
Yeah.
I can tell you how much fun it is to be able to go into a bank and say, what's your best rate? What's your terms? And if I don't like them, I just walk out. And then a banker's chasing you down the sidewalk. Hey, why can't we do business with you? I'm like, because you're way out of whack. I don't want to do business with you. When they're used to people chasing them down to do business.
Yep.
So those are the four methods. But I wanted to go back to one quick point. And this is a question I've asked a lot of different people. I said, if there's 100 people on the street, and again, they have $50,000 in savings account, and I say, if you want to buy a new vehicle with that $50,000, of the 100 people I'd asked this question, I'd say, would you put that money back? What's your plan to put that money back to pay that money back? And I would say about 80 of those 100 people would say, why do I need to put it back? It's my money, right? And then they'll sit and they'll think about it and they'll reason, if I want to buy another vehicle down the road, I probably should put the $50,000 back. So they'll start saving again. So that's the pay cash guys. So then I said, okay, if you're willing to pay it back, because you have to first get an understanding that somebody's willing to pay it back. I said, if you're willing to pay it back, would you pay it back at least at the 1% interest that you would have been paid at the bank, that the bank would have paid you? And again, people are going to come back and say, why would I pay interest? It's my own money.
Yep.
And I'm going to say, think about it. You had the $50,000 that was earning 1% interest. Why wouldn't you at least pay it back? And of those 20 people that are left of the 100, half of those aren't going to pay interest. Right? They're going to say, I'm not going to pay it back with interest. Why would I want to do that? It's my own money. Again, so then of whoever's left, I would say, would you pay it back at an 8% interest rate or a 10% interest rate? And there's probably one or two, maybe even three people of the 100 people we've asked who said, I can see why I would do that. And typically those are the people that are the wealthiest people in your community. They understand how interest works. And so the reason, going back to that whole thing, is people are conditioned to think that, hey, I don't want to pay interest. That's an awful thing. Unless, of course, you're the owner of the financial institution.
Yeah. And it is a complete paradigm shift to think about. We have been so conditioned. Even as you're talking through this, I'm thinking, and I've heard this story multiple times, but I'm thinking through, what would my answer to that be? What would that be? Would I be willing to pay 8 or 10% interest? We've been so conditioned to think that we want to avoid paying interest at all costs because it's bad. It's money in somebody else's pocket, not money in our own pocket. But turning that around and saying, what if you are the person or the entity that's getting that?
100%. Agree. And the other side of the equation, and this is where the whole idea behind economic value added comes into play. What could you have done with your money had you not purchased that car, for example? Could you went out and buy a piece of real estate that could have generated 8% or 10% or whatever it might be? And again, you get to determine what that rate, but you realize it's coming out of your own pocket. So it's just saying, I understand there's a cost, opportunity cost of putting my money to work here versus somewhere else. If I can't put it on the street, again, I'm just another customer of my own bank. If you're my customer, Nicole, I'm going to charge you 8% for borrowing money, so why wouldn't I charge myself the same? And by doing that, you're saying, if I put my money to work, if I use that $50,000, what if I could have lent it to you for 8%? Then shouldn't I at least pay it back at 8%? Because that's lost opportunity, lost money that I could have had I left it there and not bought the vehicle by the use of my cash. And that's the hump that so many people have a tough time getting over.
Yeah. Another way of looking at this where people don't want the car payment in cash because I don't want to make the car payment every month. I want to have that money. So obviously, if that's what they're doing, they're not saving for the next purchase. But that they want to save that money. They don't want to, what they're saying, spend that money on a car payment. But most of them aren't saving the money.
They are. And so then the next time they want to, you have a payment no matter what you do. Really, in all reality, if you're an honest banker, you have a payment no matter what you do. You go to Wells Fargo to finance it, you got a payment. If you do it with cash, you have a payment. If you do it through the infinite banking concept, through your own family financing system, you got a payment. The question is, who's going to control and reap the benefits of that payment? And if you don't have a payment, then you're just stealing.
Yeah, if you don't have a payment, then apparently you aren't ever forever.
Yeah, forever. And again, it goes back to the statement. We have to love ourselves and our family more than we love Wells Fargo. Because if we took a loan from Wells Fargo, you sure better believe we would make that payment each and every month. But when we do it to ourselves, why are we willing to put our family and ourselves second and put Wells Fargo first? Treat ourselves better, our family better than what we treat Wells Fargo. I don't know, like I said, I could probably do a whole podcast just around that idea, but it's this idea of not making payments because you don't want to make a payment. Buying something, you're getting something, there is a payment attached to it. Know it or not, there is a payment attached to it. You can either choose to recognize it and make it and control the system, or if you don't, then somebody else is going to control you.
He goes through the table on page 45 and lays this out. And I can tell you the first time that I read this book, and I'm not really good with looking at this sort of thing and how, okay, what exactly is he doing? But it is time and sit down and say, okay, I see all of these different methods. And then he says in here somewhere that the difference between the two columns,
that's
page 43. Look at
43, about 3/4 of the way down.
Yeah, and compare the two methods. The difference is what went to the stockholders at the bank in method D.
Yep. Yeah, again, somebody's getting rich. And so the question is, who's that going to be, you or Wells Fargo? You choose where you want to be. He talks about that too. He talks about Shakespeare says all the world's a play, and who are the characters in the play? All the world is a stage, and the people are actors thereon. So everybody's an actor in this play, and so we just have to recognize who the players are. And he says when it comes to the subject of finance, frankly, most people don't understand the play. Worse than that, they don't even get the characters in the play straight. He talks about who are the characters. There's the depositor, there's the hired help, the tellers, the bank president, so on and so forth, the borrower, and ultimately the owner. What if we could be in three of those positions, or be in control of at least being the owner and the depositor, and then let whoever's going to borrow the money, it might be us, might be somebody else, come in and be part of that, because that's the person that pays for everything. Remember that.
Yeah.
And the hired help is just that. They're the hired help. And we have insurance companies that have already done the hired help for us. So it's just like any other rules of the game. It's like tic-tac-toe. The first time you ever played it as a kid, you probably lost. I think about playing that with my son. So I didn't tell him what the rules were. And so I could beat him time and time again. Now he's 15. He's a pretty bright kid. It's always a draw because he understands the rule of the game. But we're like that 5-year-old kid when it comes to finances. Everybody else knows the rules of the game except for us, right? There's an old saying that says that who's the fool in the game? If you don't know who the fool in the game is, you're probably him. Because everybody else knows the rules, everybody else knows what's going on, and you're the one that doesn't. So who pays? You're the one that ends up paying. So the last part of this besides the charts, to your point, to the charts that are there, again, Nelson just used these as examples. There's so many people that want to mimic exactly what he has in this example. But it's a lot more complicated than this, right? And his time has changed. This is 20 years old where these numbers are at. So all I would tell people that listen to this podcast that are reading the book is just use this as an example. It is not the only way to show things. And he actually brings that up in the addendum. So this is just a way for you to understand how this is going to work. And it's not, at the end of the day, it's like, we may not be able to craft it exactly like this because conditions have changed over the last 20 years. And so it's just one of those things where we just have to kind of use our imagination, use the imagination that Nelson talks about. And we're not going to build it exactly like this, but he uses this just as a roadmap so you can kind of see, okay, this is how it needs to be done. Now, it's going to be different for every person that's going to be out there. So just don't think that there's just this one way and you get to do it exactly like all the illustrations in the book show it. Yeah. There's multiple ways to get it done. And then in the addendum, the other part of this is that, so when I'm talking to a client, I talk a lot about there's three things to make a policy happen, make the ability to take control of the banking function in your life. There's three things that have to happen. That's time, that's money, and that's discipline. And it's nice that Nelson kind of laid this out in page 44, right? So on the top of page 44, he talks about why does the system take some time to get built up, because he says there's going to be what everybody wants to refer to as a break-even point. And that changes for different people and different situations, but the whole point is that he talks about banks typically don't make money for the first 15 years. Typical businesses, what does it take them? 7 to 10 years before they see a real profit?
Yep.
That's exactly what we're doing, is we're building a system. And I can show on a spreadsheet. I've done the calculations where I can show on a spreadsheet where doing the CD method or doing the cash method, the CD method is actually a better way to do it. In the first 7 to 10 years, you might be better off doing it through the CD method. If you're not a long-term thinker, that might be what attracts you. You might say, that's what I want. I'll say, okay, then you're probably not going to want to work with me, because this is our lifetime and, quite frankly, the next generational lifetime. And so if that's the case, think long-term. And when we start doing that, the longer we go out, the bigger the difference is by using the life insurance policy as the funding vehicle to do the banking function in our lives. Again, maybe 5, 7, 10 years might be better served by doing the CD method. But I can show you by doing spreadsheets, not that I'm a spreadsheet guy, but it makes complete sense that if you're thinking long-term, because you want to take this, you want to have this change in your life, and it's going to be a lifetime change, then there is really just one best place to go with those dollars. And then the next one, I always say it takes money. In the addendum, there's a rule. Nelson he says, there's only two hard and fast rules in building and carrying out this concept. It's the second to last paragraph. He says, don't be afraid to capitalize your system. Yeah,
I've got that. That was my tendency, and still sometimes I have to fight against. There's this idea that into this life insurance policy and forgetting that's them. It's still my money. It's not gone anywhere. It's just in my bank instead of in Chase. So instead of in Chase's account, it's in my account.
Right. Yep. That's exactly right. Don't be afraid to capitalize. And this is where the scarcity mindset kind of kicks in, because we've been conditioned to think 401ks. Where do I put my money? Put it in a 401k. 401ks are very scarcity mindset, because I put it away because I'm afraid we're not going to have any money 30 years down the road. Yeah. And it's a consumer mindset, because I put away, sacrifice, put away, and then when I get to 65, this magic number, now I have to consume that from 65 until the day I die. Mm-hmm. So it's this consumer mindset, we have to consume something, and it's also the scarcity mindset. Where Nelson really attacks it with the idea is like, there's a line that I love using, it says, premium isn't the problem, it's the solution. The more premium, the more dollars you can put into your system, the better off you're going to be. It's going to solve a lot of your problems. So again, premium isn't the problem, it's the solution. And then the third point he makes, or the second point he makes actually in that paragraph, is don't make policy loans without making provisions for paying them back. There's so many people that don't want to pay these back. They're not honest bankers. They're stealing from themselves. Nelson used to say, if you're unteachable or a thief, he doesn't want anything to do with you. That was one of his lines. If you're not willing to learn and you're not willing to put a system in place where you treat it as well as it needs to be treated, then you shouldn't be doing this. Because it does take, this is where the discipline, right? Time, money, and discipline. Yeah. We have to have a plan to pay it back. And I've even seen practitioners that will take out loans and loans, and their point is, I'm never going to pay that loan back. Why wouldn't you? Why don't you want to build up your capital? Who gives you an interest-only loan forever? I
was just going to say, if you've got, so let's just say you buy and you don't pay your loan. What's going to happen? They're going to come and repossess your car at some point. They're going to hunt you down and take your car, and now you have no car. And So why do we pay that loan? Because we don't want it repossessed. Why would we not pay ourselves back?
Because if that happens, it's going to be like the First State Bank of Texas in Midland, Texas, right? Where it was one of the richest banks during the oil boom of the 70s and 80s, but it went bankrupt because all its board members had defaulting loans.
Yeah.
The majority of its defaulting loans were belonging to their board members. The same thing's going to happen to your banking system if you treat it that way as well. Any business, think about that. If you're selling, again, go back to the grocery store. If you steal peas out the back all day long, then you have no inventory. Then you shouldn't be shocked when you get to the point where it's like, hey, we can't even make a profit. It's so far down the hill, we can't even make a profit. It's the same thing here. This is just another business that has to be just as profitable as any other business you own or run. So there's a couple other things that are in this chapter, but it is a powerful chapter because this is really where people get started. And I get probably more comments and questions out of this chapter probably than any other chapter. Just because there's a lot that's being talked about. There's a lot of, okay, I need to start. This is where I'm going to start. Then again, they want to go right to the top and take on that mortgage. I'm like, let's take a step back, and let's address kind of all the other debts you have. And let's make sure we perfect the system, our process, before we tack the biggest one that's out there. And then understand that when you use your money and put it to work, that it has to be treated fairly. It has tremendous value, so let's use it like it has tremendous value. And that's to make sure we're paying it back with a reasonable interest rate. And then again, it comes back down to time, money, and discipline, right? This is a lifelong venture. This is something that you're going to change your life. It's going to change your life, and it's going to take a lifetime to change. And it takes money, so don't be afraid to capitalize. And then the hardest part, I can show you by spreadsheet the first two why it makes sense. The hardest part, the thing I can't teach you, Nicole, unless you're really good, I don't know that you can teach somebody else, is discipline. It's either something you have or something you don't have. And that has to come from within, because you have to understand that once you own and control your own, there's nobody that can tell you no to any kind of...
Yeah, there's a level of trust there too, Wade. And so for us, there has to be a level of trust of, look, I know this is a new thing. I know that you're still going to have questions, and you may have to come back and get clarification or remind us. But there has to be this, walk you through this process. I'm going to process. So when there are questions and when there are, that we can come back and help you through that.
Yes, I would agree. Education's a process, not an event. We have to fight the arrival syndrome. I have to fight it. You have to fight it. Really, all practitioners. Nelson talked about having to fight it all the time. We should never get to the point where we think we know everything there is to be learned. And we should learn everything we can along the way from other people, from having conversations. So I've had clients, I just called with a client the other day. He's had policies for now 10 years. And he's just really getting used to using the system. So it's a process. And it has to be revisited and has to be used. Nelson has a chapter he calls Use It or Lose It, right? We have to be using, it's like a muscle. We have to be using it, flexing it, putting it to work. Other words, it becomes soft and goes away. So I agree. There's a level of trust, but there's also got to be a level of engagement from the client to me. I've had clients that, for whatever reason, did not engage with me. I've given plenty of opportunity to have a discussion about how you're using your policy, how you're using the system, getting questions. They've never engaged. And those are typically clients that will go by the wayside. And I feel bad for them because it's a tremendous tool. But again, we can only do so much. We can lead them to the water trough, but they have to have the discipline inside themselves to do the things that are right. And I love having those conversations. I love having strategy conversations around people like, hey, how do we put our money to work? What can we do with this? And depending on what industry you're in and what where you're at in your life and so on and so forth, there's a million different things. There's an infinite amount of things that you can do to put your money to work. You just have to find that kind of excites you and grabs your interest to do it. So we talk a lot about real estate, but that's not meant for everybody. You might say, I don't want all the headache, and I don't want the 3 T's, right? The toilets, the termites, and the tenants. So maybe real estate's not for you, but there might be other ways to do it. And we're talking to people constantly on how they're doing it differently. So that's, to your point earlier, this is why building that community around you of IBC clients, people that are doing IBC, let's find a way to build those people around you, and you're going to help them and they're going to help you, and it's going to be so much easier. And then get a practitioner like myself or you, Nicole, we can come in and we can give ideas of how to use the process and how to, in essence, come in and teach and mentor people on how to use those things as well. But building a community around you is going to be the first thing that's going to be really beneficial.
Absolutely. And it's really cool because when I first started doing this, I was very limited in my thinking about me and my own family. But as you begin to put your feeler, say, how else would I do this? Who else is looking for money? There are so many things out there, and some of them will make you go, that's not me. And some of them make you go, oh, I like that. It's different for everybody.
Yeah, exactly. I've heard clients buying tax liens, doing cash machines, there's even one person that's talking about doing ice machines out there. And all it takes is money and then the right financing to make it happen. Real estate, there's just numbers of it's infinite. It truly is infinite. That's why I called it an infinite banking concept. So, well, that's where we start. That's building your system, understanding that taking control of the credit's the most important thing.
Not being afraid to capitalize your system.
Not being afraid to capitalize your system, and then having the discipline and truly having a system of, okay, we're putting it to work. And this is where we actually get into talking about using a segregated account and having documentation that kind of flows with every transaction. Again, that comes from a seasoned practitioner. If you understand that, if you're a practitioner, something I've done for a lot of years, Nicole, I know you and I've talked about it, having those systems put in place, because then it becomes like a real loan. It becomes like a real business when you start doing that. Versus this, something that's up in the clouds, this ethereal thought process. It now becomes a rubber hitting the road type of system that you can actually put to work for you.
Yep.
Well, that's fabulous. Like I said, I'd love to have more discussion. There's a lot more discussion to be had in that chapter, but that gives you a high level view of what's going on in that chapter. So
premium isn't the problem, it's the solution.
Premium isn't the problem, it's the solution. That's exactly right. So if you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.